Hello, I'm Brian Lucareli, Director of our Private Client Services Group and co-chair of our Family Offices team here at Foley and Lardner. And I'm here today with Spencer Moats, a partner and member of our transactional practice and a leader of the firm's private equity and venture capital practice. Welcome, Spencer.
Welcome, Brian. Thanks for having me.
Yep, and today Spencer's going to discuss current M&A challenges and opportunities. But Spencer, before we get started, it might be helpful for our audience if they knew a little bit about your professional background. So if you could just spend a moment or two and just share a little bit of your background, and then we'll jump right into the questions I've got prepared to discuss with you.
Sure. Thanks, Brian. So, as Brian mentioned, I'm a partner here in our Milwaukee office of Foley and Lardner, practicing in our transactions practice group. My practice spans from middle market to lower middle market private equity, sponsor representation on the buy and sell side. I also represent a number of strategics, including publicly traded companies locally, with their mergers and acquisitions activities, as well as dabble in 34 Act and 33 Act transactions related to securities issuers. I've been with Foley here for roughly 17 years, and am excited to speak on some of the challenges and opportunities that are facing acquirers in today's M&A market.
So great. Thanks for the background. And we clearly have the right person chatting on these subjects today. So again, the remind our group, Spencer's going to talk about some of the challenges in the M&A space and those opportunities. So kind of question number one, let's get started. So, what are some of the adverse market conditions currently affecting the M&A space from your perspective?
Sure. So, as many people listening may be aware, the pace of mergers and acquisitions in 2021 was torrid, and you might say a record pace. And some things have changed relatively dramatically since 2021 that have caused that to slow down somewhat in the first half of 2022, but is certainly what we saw in the third quarter. The first of those is obviously the high inflationary environment that we're currently in, rising commodity costs. So it's resulting in business operating at a level of profitability much less than they would have been prior to these increases, which then, of course, when you slap a multiple on that, results in lower valuations and makes an exit less attractive to a potential seller. It also, with respect to a potential buyer who's looking forward at the inflationary environment that we're living in, they see the lower possibility of returns given the cost to operate the business have gone up. We've also experienced a significant increase in interest rates over the course of the last 12 to 18 months. These higher interest rates obviously increase the cost to acquire an asset,
Right.
particularly obviously those that are using debt capital to acquire. And then, similar to the inflationary environment, as costs increase for the acquired company, so does the return on investment decrease. We've also had substantial volatility and lessening of market value in the equity markets. What that's resulted in is kind of twofold. First of all, you've got strategic acquirers who may have been active, but given the decline in their own equity value, it may have taken a pause to focus on their own balance sheets and kind of weather the storm. It also decreases the value of equity as acquisition capital. Obviously, if your shares are worth less, then using those shares as consideration in a M&A transaction goes down. And then finally, we've dealing with an ever-changing regulatory regime. And the
Right.
one specific example I would point to is as it pertains to SPACs. So SPAC transactions kind of artificially bolstered M&A activity, particularly in the first half of 2021. And as things have changed and they've become less attractive, the SPAC volume has gone down significantly, and that's had a corresponding impact on total deal volumes to date.
So that's a great segue into my next question, and is based on what you're seeing, how have these adverse market conditions impacted both deal volume and deal values in 2022?
Yeah, so I mean, my personal practice, I've certainly seen a slowing in the pace and the number of transactions. That experience is supported by some published evidence. Specifically, S&P has reported that for the first half of 2022, deal volumes of reported transactions were down roughly 15%. And the aggregate deal value for the first half of 2022 as compared to the first half of 21 was down roughly 20%. In both cases, that's skewed a little bit by the significant decrease in SPACs, which were down 22% year over year. So the numbers are marginally skewed, but in any case, it does reflect that there's been a slowing in the M&A markets as a result of some of the conditions I've articulated. That seemingly accelerated, at least according to Bloomberg, in the third quarter, which is consistent with my personal practice as well. Bloomberg reports that reported deal activity in Q3 was actually the lowest it's been for any reported quarter since the first quarter of 2017. So certainly some fairly significant slowing, particularly most recently.
Yeah, so let's reframe the optics on this. And my question is, so hearing some of the challenges, what are those opportunities does this current adverse market create for M&A? Both for buyers and sellers.
Right. Well, certainly on the buy side, it creates an opportunity for perhaps a different kind of buyer. So if you've got a cash-rich buyer, such as a strategic with a lot of cash on its balance sheet, or debt capital that they locked in prior to the increase in interest rates, family offices would be another example. It's an opportunity then to re-enter the market and look and potentially acquire some of these more attractive targets at valuations that are reduced from where they were even a year ago, and potentially with less competition given the absence of some financial buyers for the reasons we've discussed. Moreover, the decrease in valuation since they've resulted presents an opportunity for strategic and financial buyers alike to acquire the same quality assets they would have acquired a year ago for a price that's much less. In doing so, this will mitigate the cost of capital challenges they're facing, the inflationary challenges they're facing. Obviously, you pay less on the front end. Even if you spend a little bit more money to operate the business, in theory, your returns will be a wash. At least in my private equity practice, I've seen a lot of the financial sponsors not doing as many platform acquisitions this year, but focusing a lot on smaller bolt-on acquisitions where they're bolstering an existing portfolio. These smaller transactions typically don't involve debt financing, so they don't really have exposure to the debt markets that have been problematic. It also helps them kind of, weather the storm relative to the ultimate exit of the portfolio, because they're kind of building and adding to its value as time progresses and kind of waiting out the storm until values recover, and there's more, attractive market for an exit. I think the final opportunity you'll see, Brian, is, and we saw this, in prior recessionary type periods, is the potential for distressed M&A. You've got companies whose profitability is at nil or not profitable at all, and they're forced to sell in a bit of a fire sale, and it gives savvy, opportunistic buyers an opportunity to acquire assets at significantly reduced values.
No, that's great insight, Spencer. So, are there just some other general M&A trends that you're currently seeing out there that you haven't kind of touched on already?
Yeah, sure. And I think some of these are relatively intuitive, just given the circumstances. So using non-cash consideration, I guess is what I would refer to it as, acquisition capital. And the most obvious example of that is rollover type transactions, private equity situations, for example, where a seller reinvests a portion of the proceeds into the equity capital of the acquiring holding company. It decreases the cash outlay for the acquirer. Has the sellers, if you will, put skin in the game, and then they're all kind of riding out the storm until an ultimate exit. I've also seen, wouldn't say a reemergence, they never really left, but they became less frequent. The frequency of earnouts, using various metrics, whether it's revenue most commonly or EBITDA or otherwise, have come back as well, to kind of bridge that valuation gap between where sellers were accustomed to being the last couple of years and where current market conditions would warrant. Buyers are saying, yeah, well, we might be happy to pay you that valuation multiple so long as you can prove out the projections that you've set forth. I've also seen, and this is a trend that's been going on for years, but it's becoming even more and more prevalent, and that's the use of representations and warranties insurance. And so there's a couple of reasons for that. Mostly because if values drop beneath where a seller was expecting to be, and they're forced to transact at that lower value, one of the ways in which a buyer can sweeten the pot is to say, look, seller, we'll give you a complete walkaway deal. Breaches of reps and warranties and the like are going to be covered exclusively by the rep and warranty insurance policy. You don't need to worry about putting aside money in an escrow. You don't need to worry about, post-closing clawback of your rollover equity or what have you. Once we're done with the deal, we're done. And that's one way to bridge a valuation gap as well.
It's interesting.
Another thing I'm seeing is kind of again, I don't know that refocus is the correct word, but certainly more attention being paid to due diligence relative to what we may have seen in the recent past. M&A had gotten to the point with all of the dry powder from private equity on the sidelines, with the basically free debt that was out there and available for financing acquisitions. And it was like a race to see who could acquire what and the fastest. And some of the attention that had been paid on due diligence, particularly now that we've introduced representation and warranty insurance, went away. What I've seen recently is that there's kind of a refocus on due diligence. Let's prove out the projections that the target's given us. Let's carefully analyze what the impacts of inflation and some of the geopolitical condition and other market conditions are going to have on this business on a go-forward basis. And let's make sure that if we're forced to provide a walkaway deal and rely exclusively on insurance, that we've, crossed our T's and dotted our I's as it pertains to evaluating the legal risks as it pertains to the business.
No, that's great. So last question, I promise, and I appreciate your insight so far. So what, and I've got to leave our audience with some practical advice. So what advice can you provide to buyers and sellers kind of in this current environment? Because it is a unique one when you look at just the general economy and marketplace, and that is global in nature. So any practical suggestions that on both sides of the house you could share?
Yeah, well, I mean, I guess I would say, and they kind of fall in two categories. One would be the category where you're uniquely positioned, as I noted earlier, as a cash-rich buyer, whether it's a family office or strategic. Kind of as I explained earlier, now's an opportunity to potentially pick up an asset that may have been off limits to you a year ago. The valuations have come down, the competition, at least theoretically, has reduced. And you may have the opportunity to get in and scoop something up at a price that's more palatable for you that you wouldn't have been able to do a year ago. I would recommend, consistent with what I've been seeing, in terms of trends, to focus on due diligence for all the reasons I articulated. We certainly have been assisting clients with doing so and reminding them all of the reasons why diligence was important before things got out of control. Right. And then finally, to the extent that you're not an acquirer in this market, either because the cost of capital is too high, the uncertainty in the regulatory environment, whatever the case may be, maybe this is a time to refocus on your own balance sheet. Pay off some high interest debt to the extent that you have any on your balance sheet. Invest in technology, which may be through mergers and acquisitions. It may just be through capital expenditures. Refocus on sales and marketing and some of the things you can do to bolster the performance of your existing business without always seeking to add on, that next thing. And then as time progresses, the market will no doubt recover for M&A, and you can refocus then on acquiring attractive assets.
No, absolutely stellar advice. And so, Spencer, I want to thank you for your time and your valuable insight today. And I also want to thank everyone for watching our presentation. And as always, for more information, please visit us at foley.com under Family Offices. And thank you.
Thanks, Brian.